Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Bill. It's really an honor and pleasure to have you on the podcast show. I do remember reading the first edition of your book, Four Pillars, back, I think it must have been back in 2003 or 4 when I read it. I know the book came out in 2002, so it's great to have you on.
Okay, my pleasure.
Now, before we go into the meat of our conversation, I did want to ask you something about your origin story, because it is somewhat different from many of my guests, because you've had somewhat of a roundabout way to get into finance. So maybe could you tell me what you studied at university and what your initial career was before you ended up focusing on finance?
Well, as you might imagine, it's a shaggy dog story. I started back in the 60s thinking I wanted to be an academic physical scientist. So I went and got an advanced degree in organic photochemistry. And then I decided I wanted to eat. So I segued into medicine. And I practiced that for well over a quarter of a century. But I realized that I lived in a country that didn't have a functioning social welfare system, and I was going to have to provide for my own retirement. And I approached it in a way that I thought anyone with scientific training would do, which is I reviewed the peer-reviewed literature, read the basic texts, collected data, built models. And when I was done, and this gets into the early to mid 90s, I realized I'd put something together that really wasn't available for small investors in terms of portfolio theory, Markowitz, that sort of thing. And so I hit the web, which was just coming to my neighborhood in the mid 1990s. And I put a book online, Intelligent Asset Allocator, and eventually it got published, and people began asking me to manage money. So I partnered with a woman who had a lot of investment experience in the investment business named Susan Sharon, and we founded Efficient Frontier Advisors. And I realized that I enjoyed writing not only about finance, but about history, which is a big part of finance. So I put out several history books along the way as well. So that's the long story short.
That's a great story. I don't think I've had any guest that's had that type of background before. But it seems like the common thread to it all is this scientific mindset, it seems, that you obviously applied in your medical career, but also in finance as well.
Yeah, and one of the things that happens to you as you get older is you realize that you do eventually realize the math only takes you so far. And you know, there's a quote that I kept turning over in my mind from a man by the name of Robert Kaplan, who's a historian. And he basically said that half of everything is geography and the other half is Shakespeare. And it occurred to me that almost exactly the same thing is true about finance. And that is that half of finance is math, and the other half is Shakespeare, and you have to mind both of them.
And let's start with the Shakespeare side in terms of what you mean by that. Is that to do with the understanding human nature and the human condition?
Yeah, it really has to do with three things. Number one is that human history and financial history is a very cruel mistress. It will throw things regularly at you that you're going to find very hard to deal with, no matter how well you plan. The second part of the Shakespeare of investing is, what Shakespeare wrote about. It's hubris. It's the face staring back at you in the mirror who really wants to make you poor, and learning how to deal with that. And then the third part of the Shakespeare is the social psychology. It's not just your own psychology, it's how you interact with everybody else's psychology. And this is one of the things that you discover when you plumb the depths of social psychology and neuropsychology, is we're not the independent thinkers we think we are. We are a lot more affected by everybody else around us than we would like to admit, no matter how iconoclastic and independent we think we are. We're all affected by what people are telling us in our environment.
And I guess this kind of backdrop sets a scene for this book that you wrote, Four Pillars of Investing, which I think you originally published in 2002, and you've come up with a revised edition this year, I guess. And so maybe we could go through what those 4 pillars are. First of all, why 4 and not 5 or 10 pillars? Is there a reason for that?
Well, it's just that I identified 4 skill sets that are essential for anyone to be able to invest successfully. So those are, just to very briefly summarize, the theory of investing, the history of investing, the psychology of investing, and the business of investing. And you really have to understand all 4 of those domains to be able to succeed.
Okay, so let's go through each one of those. So on the theory side, so the first pillar, how would you is there a way you'd explain that at a high level?
Well, it's something that I think anyone who does finance understands well, but not necessarily every retail investor understands, which is that there's this connection between risk and return. And so it's telling people something that, you and I both know and everybody in the business knows, but which individual investors may not realize, which is that if you want high returns, you're going to have to take risk. And taking risk just doesn't mean taking the risk. It means getting slammed with that risk on a fairly regular basis. It's having your head handed to you and losing a large amount of money. And that's just part of the game, is being able to absorb that. On the other hand, if you want perfect safety, you're going to get low returns in general. So that's the first pillar. And then, of course, there's the more nuanced stuff. There's Markowitz, how diversification works, and the Tobin separation theorem, about how to think about your portfolio as being having a risky part and a riskless part, and the psychological benefits of being able to do that. So that's the theory of investing.
Yeah, and just on the risk side, the conventional way, at least professionals would look at risk, is standard deviation of returns. Do you have a favored way of measuring risk? I mean, you explained it in more colorful terms, getting your head handed to you and so on. But which standard deviation doesn't really kind of give you that sense. But do you have a measure of risk, or how do you sort of define risk?
I tend to think of risk very holistically, not in terms of one parameter. Sure, standard deviation volatility is a good measure of short-term risk, but even that doesn't really cut it, because it's not just how much volatility you have, it's when you have the volatility. So it's the difference between a junk bond and a cat bond. All right. A junk bond is going to clobber you just when you need the liquidity the most. So even corporate bonds don't function very well in a really, really bad state of the world. If you want liquidity with which to participate in the fire sale, or merely put groceries on the table when you lose your job, you better not be depending upon corporate bonds. You need something with a government guarantee, which in the US means, of course, a treasury bill or a cash equivalent or a certificate of deposit, which is under the $250,000 limit. So that's one measure of risk. Now, on the other hand, a cat bond may clobber you, but it won't do it during the worst. Generally, do it during the worst of financial times. So the corollary of that is you should expect a lower rate of return on a cat bond than on a junk bond or a corporate bond. So that's risk in the short term. And the problem is that as human beings, we suffer from risk aversion myopia. We tend to think more about short-term risk because that's how we evolved. The hiss of the snake in your ear, or the yellow and black stripes in the periphery of your vision. You better be able to react short term. Unfortunately, in a modern post-industrial society where you've got a time horizon not of seconds but of many decades, that doesn't serve you very well. And so the real risk that I tend to think of is what I call deep risk, which is having a significantly negative real return over a period of a generation. In other words, something that is going to put you under an overpass in the rain when you're old. That, to me, is the more important measure of risk. So there's shallow risk, which I described, and even then, standard deviation doesn't cut it because you have to think about when the risk occurs. Bad risk, bad returns in bad times, or I like to call it Ilmanen risk after Antiomanin, who writes about that at AQR. And then there's deep risk, which I consider the more important risk.
Yeah, that's a great explanation. And just for our listeners' benefit, a cat bond, can you just explain what a cat bond is?
Oh, I'm sorry, it's a catastrophe bond. So it's a bond that you will lose capital on and interest on when there's a specific event, typically a hurricane or an earthquake or a large fire.
Yeah, that's great. Now, the second pillar, you start to bring some, history, investment history. And why did you want to bring history into the equation for?
Well, because the only black swans are the history you haven't read. And the more history you read, the more better prepared you are. I'm very fond of, as someone who did fly airplanes at one point in my life, of aviation analogies. And a competent pilot reads accident reports on a regular basis, and he or she reads accident reports so he or she does not make other people's mistakes. And I think that a reading of financial history serves you the same way. You want to learn about, manias. You want to learn about panics, not necessarily so you can avoid them or time the market, but just so you know that they can occur and you're not surprised and you don't lose your nerve or your cool on the upside when they happen.
And just on the tangent now, this aviation hobby of yours, how did that happen?
I've always, ever since I was a little boy, I wanted to fly airplanes. And finally, when I practiced medicine, I got the opportunity to do it. I bought an airplane and would fly to outlying clinics. It was great fun while it lasted, and like everything else, it got old.
Wow. Okay, great. That's a great little additional feather to your cap there. Now, in terms of history, then, I mean, what are some of the important, I know, texts you've read or lessons you think we should learn from history?
Well, back 30 years ago, I read a book by Charles Mackay, Scottish journalist and poet, who wrote a book called Memoirs of Extraordinary Popular Delusions and the Madness of Crowds. It's been in print ever since it was first published in 1841. And I read about the financial manias, which is the reason why most people read the book. It's got a lot of other manias described in it as well. And I thought to myself, well, this is all very interesting. It must have been fascinating to live through something like that. I didn't think it was terribly relevant. And then maybe 3 or 4 years later, the dot-com bubble erupted. And I thought, I've seen this movie and I know how it ends. And, the $5 or $10 for the used copy that I paid for the book was easily the best investment return I've ever earned, millions of percent of investment return on that one small purchase because it saved my bacon, back in the late 90s.
No, that's
And
great.
by the way, my experience wasn't unique. That book's been in print for the past 180 years, and it's been saving investors bacon almost that entire period of time. Bernard Baruch wrote the preface to the introduction to the 1932 printing of the book simply because he was so grateful because it enabled him to sidestep the manias of the early 20th century as well as in the 1920s.
And in terms of manias and bubbles, then, I mean, do you think that history can give us some idea of what the common ingredients are of manias over time?
Yeah, this is one of those things where the Shakespeare served you a lot better than the math. People have tried, ever since the time of Isaac Newton, to model bubbles unsuccessfully in Newton's case and ever thereafter. And really, that's not the way to approach bubbles. The way you approach the bubbles is with the Shakespeare, the sociology, and so you identify the common characteristics of bubbles, and there are basically four of them. Okay, the first one is when you go into an Uber cab and your driver starts telling you about his crypto investments, or in Joseph P. Kennedy's famous apocryphal story of the shoeshine boy giving him tips. You're at a top. It's when finance becomes topic A at all social gatherings and social interactions. The second way you identify it is when people leave otherwise good paying, solid jobs to trade. We saw that with day traders back in the late 1990s. We are seeing it now with crypto as well. And you saw it in the 1920s when people left perfectly respectable professions to trade. The third thing that you see sociologically is something which isn't commonly recognized, but I've learned to recognize it, and other people have as well, which is when skepticism is met with hostility. All right. So back in the 90s, when I told people I thought there was a bubble going on, some people got very angry at me. They got red in the face. They told me that I didn't know what was going on. And there was this common phrase that you heard back then, you hear even now, which is "you just don't get it." All right. When you hear that, that's a sign of a bubble. And the interesting thing is trying to figure out why that happens. And I'm pretty sure the reason is there are a few more pleasing narratives in the world than the narrative that tells you you're going to get effortlessly rich by investing in this or that asset. And you're not going to be very happy when someone tries to disabuse you of that notion. And then the final thing you see is extreme predictions. So, for example, when a certain tech entrepreneur says that Bitcoin is going to go to $500,000, and if it doesn't happen, he will perform an act on himself on public television that requires a great deal of spinal flexibility. When you see that sort of extreme prediction being made, then you know that you're in a bubble. So that's to me where the Shakespeare helps you a lot more than the math.
I like that. The very sort of colorful explanations there. So let's move on to the third pillar where you talk about investment psychology. So how do you think about that?
Well, I tend to think, neuroeconomics and the research of Kahneman and Tversky have gotten to be pretty fashionable. In fact, not to take away from the importance of their work, it's very important work, but it's gotten to be a little too fashionable. And I find the social psychology to be much more valuable. So there was an experiment done by a social psychologist over a half century ago by the name of Solomon Asch. And what he would do is he would put subjects in a room, and they would guess what line rents were. And it's hard to, I should have had the example here, but he would have two cards, and one card would have a line, say, that was 3.5 inches long, and the other card would have three lines that were either, say, 3.25, 3.5, or 3.75 inches long. And that is a task which is just difficult enough that you'll get it right maybe 99% of the time. There will be an error rate, but it will be small. But if you put a subject into a room with confederates of the psychologist who look like subjects but really aren't, and they start shouting out wrong answers, then people will tend to repeat those errors and shout out wrong answers too. Not everyone does that. A quarter of people seem to be impervious to it, but 3/4 of people will see a significant deterioration in their performance. And so that, to me, is what happens during bubbles, and that's where the psychology and the social psychology is important. The single most important bit of neuropsychology, personal psychology, is of course overconfidence. People think they can time the market. People think they can pick stocks. People think they can pick successful money managers, and all of the data that you look at tells you that they can't. But to my mind, there's an even more dangerous psychological fallacy having to do with overconfidence, which is overconfidence about your ability to take risk. People run a spreadsheet and they say, yes, I can afford to lose 50% of my money in stocks temporarily. But when the excrement actually hits the fan and they actually lose 50% of their money, they don't do so well psychologically. And so, that to me is the worst overconfidence. It's overconfidence about the ability to take risk. So that's the important psychology of investing, I think.
And on the point about us, following what other people say, even when it's wrong, does that mean that we should avoid consensus ideas on trades?
Yeah, of course. Successful investing is a intensely solitary activity. And the further you are removed from the action, as it were, the better off you are. For God's sake, stay away from social media.
Yeah, that's a great general piece of advice as well, I think. Okay, no, that's great. That's very clear. And then on the fourth pillar, you talk about the business of investment.
Yeah, and that is a relatively happy story. When I wrote the first edition of the book, most of the finance industry was a no-go zone. You just didn't want to be anywhere near most advisors, certainly most stockbrokers, and you wanted to stay away from most mutual fund companies as well. In fact, when I first wrote the first edition of the book, there was really only one company an American should have been dealing with, and that was Vanguard. And what has happened, as we're both aware, over the past 10 years, is there's been this revolution in finance, this race to the bottom, where large financial institutions are just knocking each other out with, basically zero commissions, trying to make the thinnest of spreads on the trades that they do to you, and the thinnest of commissions on their mutual funds. And that has greatly benefited investors. It used to be that if you took your money to one of the big full service brokerage firms in the United States, you're going to get bled on average by 2 or 3% per year. Well, it is now perfectly possible to have an account at a big bad old brokerage firm, whose names we all know, and to pay essentially no commissions or fees and pay minimal expenses on the ETFs that you can buy. You can buy a Vanguard ETF at Morgan Stanley if you want to, and have the same expense ratio. So that's been a marvelous thing that's happened. So in a way, that's a happy story.
And you said when you wrote the first edition of Four Pillars back, I guess 2002, that wasn't as much of a case. But what other things have changed over the course of 20 odd years since you wrote the first edition?
Well, I think it's basically what I talked about, which is expenses have fallen. Vanguard's first index fund, I think it was called the First Index Trust, the First Investment Trust, FIIT, I'm not sure what the other I was, had an expense ratio on the order of about 60 basis points. Well, now that same fund has the ETF version, I believe, has an expense ratio of 3 basis points.
Yeah.
That's been the story of the investment industry. It's no longer, it's still possible to make a good living abusing your clients, but it's becoming harder and harder. That's been the big change.
And in terms of the other pillars, have your views changed or evolved as well? The first, second, third pillars over that period of time?
Yeah, the biggest change, the two big changes are, number one is what I already talked about, which is the importance is de-emphasizing the math, if you will, and paying more attention to the other three pillars and less to the first pillar, the math. The second change that's made is the realization is that I took a strictly mathematical approach to portfolio theory and just talked about the portfolio as a unitary being. In other words, really all that really mattered was the return and volatility of your portfolio. And I've come to realize that that's not adequate for dealing with the Shakespeare. You need to think of your investments as two completely separate pools. You need to think of your risky assets that you can basically kiss goodbye for a period as long as 5 years or 10 years, that will hopefully earn you high long-term returns along when the journey is finally done. But you need a nice, safe pile of assets to see you through that worst 2% of the time, because you don't earn the magic of compounding if you interrupt that compounding. And you're most likely to interrupt that compounding during the worst 1 or 2% of the time. And that's where a nice, safe pile of assets really sees you through, so you don't lose your nerve and interrupt your compounding. Everybody thinks they're going to be a long-term investor and they'll see it through. And you are fooling yourself if you think that that's the way you're going to react in the moment.
And so if you have like an imaginary person who has some level of savings, they want to invest it in the way you describe in your four pillars, taking into account this idea of risky versus risk less or lower risk, how would you construct a portfolio? And just to make it a bit more interesting, the benchmark, so to speak, is almost 60-40 portfolio, which seems to be what everyone gravitates towards. How would you compare it to that?
Well, the 60-40 portfolio is the standard because that's pretty much what the world's capital markets look like. I think they're maybe a little heavier on bonds than that, but it's not an accident that people gravitate towards the 60-40 portfolio because that's about what the global market basket of tradable securities looks like. So it's not an accident. And I tend to think of it, as the life cycle. You start with the theory. You do have to start with the theory that says that if you're a young investor, you should invest 100% in stocks. And the reason for that is not just they have the highest long-term expected returns, but also because a young person has an enormous amount of human capital, that is earnings potential, relative to their investment capital. So you could be theoretically 300% stocks when you're young, because that's still dwarfed by your human capital. Now, as a practical matter, there are very few sentient beings in this quadrant of the galaxy that can tolerate a 100% stock portfolio, let alone someone who's 22 years old or 28 years old. And so I recommend to young investors that they start out with something close to 50-50, so that when they have their first bear market and the narrative says that the banks are all failing and our financial system is collapsing, or there's a pandemic that will completely destroy the global economy, or that Kim Jong-un is about to push the red button, the big red button, that they don't lose their nerve. And then they see how they respond. Okay. And if they sail right through it and they buy more stocks, well, then God bless. They increase their stock allocation. So now this person is 40 or 50 years old. They have a lot of money, hopefully a lot of investment assets. How do they allocate? Well, it depends upon what their burn rate is going to be in retirement. If they're only going to have a 1 or 2% burn rate in retirement, then they can have a very stock heavy portfolio, which they should know by then whether they can tolerate or not. On the other hand, if it looks like they're going to have a 4 or a 5 or a 6% burn rate, that person needs at some point to start lightening up. And at least in the United States, to me, it's a no-brainer to buy inflation-protected securities, because that's what their future liabilities are denominated in, which is in real dollars. So if you've got a 5 or a 6% burn rate and a large amount of retirement assets to invest, a significant part of that should be aimed at defeasing your future living expenses. So a ladder of Treasury inflation protected securities, let's say, that will be maturing hopefully each year that you're retired. That's not quite possible. You can get pretty close to doing that, though, because of gaps in the maturity structure. So that's sort of the life cycle way I look at asset allocation.
No, that's good.
Theoretically, if you are 65 years old and you can tolerate 100% stock portfolio and your burn rate is 1 or 2%, well, that's the dividend of the stocks, and those will increase in the long run with inflation, probably at a higher rate than inflation. So theoretically, that person can be 100% in stocks. There are very few people like that, of course.
Yeah. And what do you make of investors like Warren Buffett?
Well, Buffett's skilled, although he runs into the same problem that everyone who's skilled runs into, which is eventually they get to have so much assets that they move the markets. So the last time I looked, like a few months ago, Warren Buffett is still slightly behind the S&P 500 over the past 20 years. He's not been able to do that. And you see that with almost all successful money managers. Now, there are two very successful money managers I talk about in the book that didn't happen to. One is Jim Simons at Renaissance, and the way he solved the asset problem was he kicked out all of his outside clients. So he only manages money for himself and for his employees. So if you're truly skilled, you don't want anybody else's money. You only want to manage your own. And sort of intermediate to that was a man by the name of Wilmot Kidd, who managed money for about 30 or 35 years, beat the S&P 500 by about 3% regularly, not regularly, but his margin didn't decline. And the reason why his margin didn't decline is he ran a closed-end fund. So he was only managing a couple $2 billion of assets during that whole period. And so he wasn't having to deploy hot money and sustain market impact costs. So that's the way that happens. So the bottom line is, yeah, there are a few skilled managers out there. And if they can restrict the amount of assets that they manage, they'll continue to do well. But
And what
good luck in finding them, by the way, ahead of time. Because for every Wilmot Kidd or Warren Buffett or Jim Simons, there are 300 people who look like them in the moment who will flame out.
and I mean, what do you make of something like Bridgewater, Ray Dalio, where he has the all-weather fund, and it's in terms of AUM is very large.
Yeah, I haven't looked carefully at his portfolio, but it reminds the way he talks about it reminds me a lot of the Harry Brown permanent portfolio, which is 1/4 each short bonds, long bonds, physical gold, and stocks. And he has those. It's a very narrative way that he explained that allocation, because they each would protect against inflation, good times, tight money, and loose money. Each, so have at least one asset that will do very well. And I think Dalio's portfolio is like that as well. He's looking to prosper, or at least save your bacon, no matter what transpires. And that's not a bad way to manage your money. I don't think it's optimal, but I think that it's one way to manage your money.
And I did want to ask a few some more personal questions outside of directly on finance. We have some youngsters listening to this call as well. Youngsters, I mean here, people who are at university, and if they were to leave, many of them will be graduating in the next couple of months. What advice would you give them as they enter the real world?
Well, the classic graduation advice is to follow your bliss, to follow your passions. That's a huge mistake, because you're very if one of my favorite New Yorker cartoons is a guy with a tin cup and a pencil in it, and his sign says "Followed my bliss," because that's likely to happen to you. On the other hand, if you decide that money is extremely important, and you head straight for that internship at Goldman, or the associateship at a large white shoe law firm, you're liable to wind up rich, but you're also liable to wind up just as miserable. And I'm not sure that miserable and rich is any better than poor and miserable. And so it's to find that balance. Find something that you pretty much enjoy doing. Maybe you're not wild about, but you enjoy doing it. You don't mind going into work, and will make you a decent amount of money in the process of doing it. Try and find that balance. Don't go hard in one direction or the other. Don't go for maximizing your income to the exclusion of everything else, and don't completely, don't decide you want to be an ethnomusicologist.
I like that. And then another question on productivity, or your personal productivity. You're obviously well read. You're covering history, sort of finance, investing in markets. I mean, how do you keep on top of things?
Well, okay, that's not quite the question I thought you were going to ask. I thought you were going to ask is what's my strategy for optimizing my creativity, and I'll get to that in
we can
a minute.
do both. Yeah.
Yeah, okay, but I'll answer the question you just asked, which is that I read, and right at the top of my list is The Economist. That's the only finance and economics that I take seriously in terms of financial media. Not even the Wall Street Journal or the Financial Times, I think, rises to the level of The Economist. But I also, that's maybe 10 or 15% of the time I spend reading The Economist. I like to say that The Economist is not a magazine, it's a full-time job. And that's a little bit of hyperbole. I probably spend 2 or 3 hours a week reading it. And then I read finance journals, Journal of Finance, Financial Analyst journals, Financial Economics, look at the FEN worksheet, that newsletter. And I still can't shake my identity as a doctor, so I have a lifetime subscription to the New England Journal of Medicine. I read that, and I read an awful lot of nonfiction. Probably the reason why I write nonfiction is it's a great way of organizing your reading. It's not haphazard. You're trying to learn something. So each book that I write is kind of like a little master's degree that I'm taking, mastering one subject. In terms of maintaining your creativity, that's the easiest question there is to answer. The answer is to take lots of time off. If you're working 60 hours a week and not taking any vacations, you're doing something very wrong. you need to cut your work time down, and you need to take weeks and weeks off every year if you can afford to do it, so that you stay fresh. When I come back, I mean, I don't have vacations anymore because I'm only working 3 or 4 hours a day, and even when I'm traveling, I'm still doing a little bit of reading. I almost that part of I don't that there's really no separation between vacation and work for me anymore. But when I was working and I had a job, then I certainly took lots and lots of time off, even when I was practicing medicine.
Yeah, no, I'd agree with that too. Now, on books, you did say you like reading, and you already mentioned Charles McKay's book. What other books have really influenced you?
Well, probably the single most important book that I've ever read was still Tetlock's book, Expert Political Judgment, which is a study of forecasting, and what bad forecasting looks like and what good forecasting looks like, and simply the fact that human beings in general are poor forecasters. And what are the characteristics of particularly poor forecasters? And he talks about what they look like. And the short answer is they're the ones you see on television. All right, that's sort of the short answer for that. So that's number one. And then there's two books by Joe Henrich. One is The Secret of Our Success, which is the story of how human beings came to utterly infest and take over the planet. And then there's another book called The Weirdest People in the World. WEIRD is an acronym which stands for Western, Educated, Industrialized, Rich, and Democratic. And it turns out that 99% of human societies in existence today are not weird. Only we're the ones who are weird. We in Western society are weird.
So all those
And
psychology studies on the Harvard graduates is not representative of humanity.
No, not at all. And that's the first point that Henrich makes, is when you do psychological studies, you're talking about basically Stanford freshmen, and they are not representative of anybody. And then there's a book, a pair of books, which are basically the same book. One is Mansur Olson's The Rise and Decline of Nations, which describes how inevitably stable, successful, wealthy societies develop layers of special interests and rent seekers that ultimately destroy them. It happens to every single great country. And it's a little bit of a hard read. It's not a bad read, but there's a book which really nicely summarizes it and is very well written by Jonathan Rauch called Demosclerosis, which I would recommend very highly too.
Sorry, what was that book called?
Demosclerosis.
Okay.
Demo, D-E-M-O, sclerosis.
Okay, great.
Jonathan Rauch, R-A-U-C-H. And Mansur Olson spells his first name as M-A-N-C-U-R. Curious first name. So those are four. I'm sure I could come up with others, but those are at the top of my list.
Yeah, no, I've read some of them, but not all of them. So I definitely will read the ones I haven't read. Now, you did mention Shakespeare as well. What's your favorite play?
Oh, Hamlet.
Hamlet.
Yeah. I mean, it's the market. It's how you participate in the market, to be or not to be. It's the uncertainty that we all feel. And I like to joke around the family that we all behave like King Lear, but of course that's not true.
Yeah. No, I think the tragedies are great. I mean, I'm quite partial to Othello, but they're all fantastic. Yeah. Now, in terms of how people can follow you, obviously, I'll include a link to your book. What other ways can people follow you?
There's almost nothing to follow. I
Okay.
come out. I still have a website. It's called efficientfrontier.com. It's basically a mausoleum. If I post one article now to it every couple of years, it's a lot. But there's a wealth of material on there to read. And the way that I communicate is with my books. So I've written, 4 big investment books. I've written 4 big history books, and that's how you can follow me. I have been writing lately for Advisor Perspectives, and that's mainly book reviews. But that's a part-time gig, and it's mainly book reviews. I'm not sure that you'll learn a lot about me. There's really almost nothing to follow. I religiously stay away from social media. I don't do social media. I don't tweet. I just saw too many people ruin their lives doing that.
Yeah, no, I hear you on that. Yeah, I try to minimize my interaction with social media. But yeah, so with that, I mean, I'll include links to your books in the show notes, because I do agree that's probably the best way to, get into your head, so to speak. And I think, otherwise, thanks a lot for doing this interview.
Thank you. This was my pleasure.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.